Hello, Smart Monetary Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and Doug Hagren will be joining us shortly. He's having some tech issues once again, so we'll see how that works out. All right, so let's dive right in. We have a little bit of change. We had this all planned out, and then Trump one-upped us. Decided to go to war with Iran. So so this week we are going to be talking about a little bit about Iran. We'll also be talking about some other things, which actually are some pretty seismic shifts in the market. So let's dive right in. So what we're going to be talking about this week, we're going to be talking about the war a little bit and the implications, and we are also going to be talking about the big seismic shift going on in the markets. And I really wanted to get to that, but we'll talk a little bit about the war just because obviously it's top of mind. Everyone wants to hear that. So let's start talking about the war. I want to institute a little framework first, because I think it's important to really understand when you're looking at things like this. I think a lot of people tend to miss this obvious piece, but when you have something like a war, there's coincidentally a term called fog of war. Now, if you never heard of this term, it comes from actually probably 100 plus years ago when, in World War I, World War II, where you had, kind of a fog over the battlefield. So when you have fog of war, you basically have something that happened, like we went to war with Iran. Now, initially, you see a lot of reports, you see a lot of quote unquote news. You see a lot of people speculating about what's going on. I was on X. I saw lots of videos of, missiles and air, jets and whatever. And the first thing I was thinking of, wow, that's really cool. And secondly, who was taking that video? So, it's obviously fake. It's AI. But the point is when you're seeing stuff like this, you never really know what's real, right? It looks real. Your eyes are deceiving you. Right? You're going to believe me. You're going to believe your lying eyes. Right? There's a lot of fake stuff out there. So you can't really believe any of it until a little bit later. So you have to take everything with a grain of salt. See a lot of videos. You see a lot of news. Oh, we killed this person. We did this. Okay. Maybe you did. But if the president announces it's probably true. But unless the president or like the Department of War, the head or somebody of note is announcing something, it's probably not true. And even then, I would still be a little suspect. But at least that's something they're confirming. Now, if you've got a news station, I would take it with a grain of salt, right? They're trying to get your attention. So the first thing to keep in mind is the concept of fog of war is take everything with a grain of salt. Just say, okay, that's nice. But realistically, what are the implications of what this war is going to bring? Now, a lot of people are concerned about the Strait of Hormuz and oil traffic, which should be a concern. I'm not sure if that is a concern yet or not, but we'll see. I know a lot of people were surprised. Traffic has, I don't know, said been halted voluntarily. I think the last thing I looked, Iran said they're not closing it, but I'm not sure if they can. So we'll see what happens. But I would say for probably the next, depending how long this takes, this could go on for months. This could become another Ukraine. We have no idea. But if it lasts a week, then things will kind of go back to normal pretty quickly. If it lasts longer, then you might want to be prepared. And we won't know that yet because we don't know. I would imagine based on what happened over the weekend that this would end quickly, but it hasn't. So we'll see. So if this drags on, then the impacts could be pretty significant and you want to be prepared for that. Now, we've been talking to you all for the last few weeks about how to be prepared. We didn't know this was coming, but we certainly were prepared for something like this. And so hopefully you're listening to the last episodes. If you haven't, go back and listen. We'll talk about it a little bit more today. But before I want to say hi to Doug, I did want to share this one thing, which I was laughing at quite a bit. And let's see, it's not funny, but once I explain it, you'll understand. There's a thing called the I don't know what you call it. The magazine cover indicator, the Barron's indicator is what a lot of people call it. And basically when you see publications like Barron's or The Economist with something in the cover, and it's usually at the extreme end of that trend. It's usually the end of the trend. Like it almost marks the end of the trend. So if you see like Mag 7 tech bulls running through the field, I think I saw that on the cover once. I think that was like within a week of the top of Mag 7 bull market. And it just goes on and on and on. You go back in history for decades and you'll see this happen. Anytime it's on the cover, it is most likely the end of that trend. So if anyone's worried about the dollar dropping, don't. Because on the cover of The Economist, it says dangerous dollar. And on the cover of Barron's, it says dollar in decline. So I think it's official. The dollar has stopped declining because it's on the cover of Barron's. Coincidentally, that's in line with what we think, what we've thought for quite some time, is that the dollar is going to start going up, despite everyone else saying that the same. I know Stan Druckenmiller's come out and said he's short the dollar, which means he's probably looking for a whale exit. He's looking for a lot of people to short the dollar so he can start buying. A lot of that stuff happens, and when you hear it, you have to wonder, like, what's the real incentive? Either way, I would suspect, and it's I haven't looked today because the markets haven't opened yet, but I suspect that the dollar has been increasing a little bit, but it's still kind of range bound. I suspect it'll probably break out from here over the next few months, and I think this will be really close to the turning point when that happens. So now for Doug, how's it going, buddy?
Sorry, yeah, you'll notice I'm in a different environment today. So I was trying to get into my office to get on the podcast, and I went away for the weekend. And for those that understand our industry, got to be very, diligent and proactive to security. So we locked my office, and somebody moved the key, so I can't get into my office to work on my computer. So as I'm trying to get in there last minute, I can't get in. So, we're on a different platform today, and I'm sure the quality isn't as good, but hey, if it's better, I need to get a new mic. But
looks like a hotel room, Doug.
What'd you say?
It looks like a hotel room.
It does. Welcome. Well, I'm glad. I don't know. It depends if it's a luxury hotel or a motel. You just either complimented my house or you insulted me completely. So,
Doug is going to talk to us today, but he did stay at a Holiday Inn Express the last night. So.
That's right. I have no concept whatsoever. I had no concept whatsoever what was going on in world politics and events, and except for where I got to sleep last night. Although over the weekend, it was like sleeping in a cheap motel because it was a gathering of some individuals, and I'm a light sleeper, and 3 of the 4 were snoring. So I really kind of felt like I was in a cheap hotel all weekend, which certainly is going to affect my brain today. But yeah, it was a pretty interesting weekend, Kirk. All of a sudden we find out boom, news. The Ayatollah is dead. Many of his, chief political partners, I don't know, underlings are as well. We're in conflict. I heard you talking about who knows how long it's going to go. I mean, Trump came out and just said he expects it to be at least weeks. And again, we all know from these conflicts, and especially when you're dealing with a regime that doesn't want to leave, and we're dealing with an ideology, because you're not just battling Iran, you're battling Hezbollah, right? You're battling all of those spiderling tentacles. So right now, the battle isn't just against Iran. There's a lot of going on in Lebanon where Hezbollah is based, and these individuals are not going to want to relinquish power. This is a different situation than Venezuela. Venezuela was political ideology. This is obviously a different level of religious fanaticism ideology, and it's been ingrained for generations. So, again, not here to get on the political side of things, but the impact of everything that is that's going on right now. Let's face it. Regardless, and we already saw gas prices pop a little bit, as they always do. As soon as there's a conflict, boom, hey, let's gouge everybody. It's not like the supply of the gas that's currently there changed its supply versus demand, but we're going to raise the price on that because we must be concerned. They are talking, as you said, they're talking about the impact of Iran trying to, and the conflict squeezing, oil supply. But I do want to throw this out, silently over the last 5 to 10 years, America has, and it maybe goes back a little bit longer than that. America has been uh, basically moving lockstep to become the world's largest oil producer. Okay, we produce massive amounts of oil now. A lot of that we do ship out, but a lot of it gives us a different position with regards to oil supply than we were 15, 20 years ago when the Persian Gulf War and things like that happened. So, from that standpoint, it may be a huge impact to the world if there is a supply crunch of oil. But if push comes to shove, America is in a better position than it used to be in terms of absorbing that, because we have a much better access to our own supply now than ever before. And it's been something that's been silently planned and been building an infrastructure. I mean, that being said, oil prices tend to be linked lockstep with global pricing. So there certainly would be effect if this lasts longer. But I'll also say this: oil was at such a low. If you were an investor in the commodity side of things, and of course, the push of electric vehicles and solar and all that has certainly taken a lot of the luster off oil. But the reality is, a lot of those patents are owned by the oil companies. The oil is, we've talked about this for years now. Oil is still the cheapest, easiest energy available. And, so if this does go on for a long period of time, yeah, there's always a trickle down of oil. Everything, and more than ever, is made from oil. Even those solar panels and those wind turbines are made from oil, and all of the hydraulics and lubricants and things like that. So, this is, but either way, it was expected that at least, to some degree, just from a fundamental trading standpoint, that oil was going to have, probably more likely than not, one way to go, and that was up. Now, whether or not that up comes from news, or that up comes from cyclical or secular trend, or that up comes from or fundamentals, not just technicals. The reality is that we got to a point in which there was, just like anything, just like now you're talking about the dollar, Kirk, and maybe Druckenmiller is trying to push out those whales. Maybe, again, you've got to the point where the dollar was so battered down that at the end of the day, if you follow longer term trends, what has typically occurred? You see that these cycles happen to where once it goes so low that the news catches on and says, it's going to get worse. That's generally when the trend starts to turn the other direction. Why? I'll put it to it very simply, something we've all heard from the time that we could speak: buy low, sell high. And when something is really high, generally speaking, there's going to be more pressure to bring it back down. And when something's really low, there's going to be more pressure to bring it back up. Not always sometimes it's over a longer trend. Sometimes it's a spike. But, I think the war, conflict, whatever happened, certainly will put some pressure on this. But I think that, as you said, we've been talking about this for a while, not necessarily a surprise for your investor of what, if it does start to go for the dollar starting to rise, if oil's starting to rise, because they've been battered for a while anyway. And so it's expected.
Yeah. Well, we're going to get into some stuff here, because it's still early. Markets haven't even opened yet. We're still, we got 10 minutes till the market's open. The futures are open, but the stock market isn't. So it'll be interesting to see what happens. So I wanted to share this. This is actually, I found this online. It was a good illustration of pretty much the last 26 years of wars, which, looking at this, these are falling U.S. overseas military strikes since 2000. 2, 4, 6, 8, 10, 11, 12. So there have been 12. And that's all I got to say. There have been 12. Anyway, so if you're looking at this is looking at the short-term maximum drawdowns from the S&P 500 from all the military strikes. And it looks at the date, the country, 1 month, 2 month, and 3 month drawdowns. So it looks at over like 3 different time frames to see like what has the market done over that time frame. So back in 2001, Afghanistan, started as 9.25, then went up to 16.75 after 3 months. You know, if you're looking at, if you're looking at, where is it? Well, actually, oddly enough, these are all in the Middle East. They don't include Ukraine. Wonder why. I guess that wasn't a U.S. overseas military strike. Anyway, laughing at the irony there. So if you look back at Iran 2020, it was a 23% drawdown, although that also coincided with COVID. So I'm not quite sure that's exactly a perfect analogy. But if you look at most of them, you're looking at a few percent in the first month. It's not that big. In 3 months, you're looking at, somewhere between, let's say, 7 and 8. So for comparison, the average is about 7.25 for 3 months, and 2.75 for 1 month, and about 4 1/3 for 2 months. It's really not that much. So if you're looking at this and you're saying, "Oh my God, the world's going to end," is it? I don't know. If you look at the stock market, you wouldn't think so. So I wanted to bring this up just to show comparisons, because a lot of the times we think, "Oh my God, the world's going to end," until you look at history and say, "Well, actually, things won't be as bad as I think." Now, my guess, and just looking at the markets this morning, is that markets are not going to maybe deteriorate as much as we think. I don't know this to be a fact, but if I'm looking at the futures, the Dow is down. Dow's down 1%. The S&P is down 1%, and Nasdaq's down 1.5. Russell's down 1.5. Nikkei's down 2.5. The Euro's stocks is down 2.75. So you're looking at these markets. Gold's up. Crude oil is obviously up a lot, 7.5. 8.75 for crude Brent. Gasoline's up 5.25. Heating oil's up almost 14%. Natural gas up 4.25. So those are the kind of the big moves this morning. And so, okay, that's kind of expected, but I'm surprised the stock market hasn't moved a little bit more. So things that you think as a human being, our minds generally move towards the extreme. Oh my God, the world's going to end. Let me go buy all the milk off the shelves so that I make sure I have some for the next 5 years. Like that kind of human nature, that ridiculousness of human nature is how our brains work, right? And when the fear center of our brain takes over, your executive functions, or your logic, or your rational thinking gets shut off when fear takes over. That's why during COVID, people did a lot of stupid things, because fear was taking over their better judgment. And that's why when, wars happen, people lose their better judgment, because fear takes over. It's just how our minds work, right? It's not judgment. It's just how your minds work. So you should understand that about yourself. And the best way is to, when you're in those situations, is to start thinking clearly, is to, pre-think about those things to prepare your mind for any different situation. So if you're looking at this, you should understand that things in the markets probably won't be as bad as you think. Now, it doesn't mean they will, but they probably won't be as bad. You're looking at less than a 10% drawdown in the market. Now, we were actually expecting a 10% drawdown at some point in the market this year. So maybe we hit that. We don't know. We won't find out until obviously after, but it is typically the kind of thing that we would see in a year where you do need to see a pullback, and that is something that I would expect. Now, there's another piece of this I wanted to share, which is the dollar, and this is something that we've been expecting, and we shared the magazine cover indicator, the Barron's cover indicator, about the dollar, and so I wanted to share this. This was an example of what the dollar does when war breaks out. So you have a difference between an increase of 3% up to 12.5%, 12.5% being Ukraine. If you look at 9/11, it was about a almost 11% increase. The Gulf War was about a less than 5% increase. The Iran-Israel 2023 conflict was 3%. The Iraq War in 2003 was 5.5%. So You could probably expect, I would say, somewhere around 5 to 10% increase in the dollar from here, based on not not anything macroeconomic, just based on history. I don't. I'm not the expert in macroeconomics of war in the Middle East. It's not my expertise, and I'm sure it's nobody else's. And if you're listening, this is probably not yours either. You probably think you know because you listen to the news, but they don't even know because they're bobbleheads. They're not experts. So you want to, if you want to really understand, you need to find people that study this stuff a lot, and you need to listen to them. And even they're potentially wrong because it's war. You can't predict what's going to happen in war. Every time we've gone to war, oh, it's going to end in 5 minutes. Yeah, right. Every war we've been into, every conflict we've been into in the last 20 years has not ended in 5 minutes. George Bush landed on the aircraft carrier, mission accomplished. And then we've been in Iraq. We've been in Afghanistan for another, like 20 years. So, you can't predict these things. So the best that we can do is look at history and say, how has the market reacted to incidents like this? Now, I would say this is probably a little bit more significant than the Israeli attack, October, was it 10th or 11th? I always get the dates wrong, but somewhere around there, you know what I'm talking about. So the start of that. And then if you look at an actual war where we were over there, you look at Iraq in 03, that's 5% all the way up to, the 9/11, it was up to, so 9/11 is probably a bad example because that was a little different. But if you're looking somewhere between probably 5 and 10%. Now, that takes the dollar up from, I think it was 97. It takes it up to somewhere around 103 to 107. That's a significant rise from there. Now, what's going to happen? So what we ought to be thinking about is second and third order of effects. And this is kind of the lesson for today, is that fog of war is first order effects. Oh my God, there's a war. Let me freak out. That doesn't tell you anything. What tells you something? What is that going to do? Okay. So it appears as if the dollar is going to go up. That would be my speculation. Oil is obviously going up. There's probably going to be a flight to safety to the US, which is normal in this. The markets are probably going to drop. The stock market's going to drop. Okay. But what else is going to happen? Well, if the stock markets are dropping, the dollar's rising, and people are fleeing to safety, well, what are safety trades? Well, what are the ones we've been talking about for the last few weeks? If you're in the stock market, utilities, healthcare, staples are the safety trades. What else is safety trade? Bonds. Is anyone talking about bonds? No, they're not, except for us. So, we talked about this a little bit, but not enough. If the dollar's going up, and we speculate that interest rates are going to start declining. I know everyone thinks inflation is going to take off. We're going to have Oliver back on from Trueflation again to talk about inflation, but I think they're speculating. I think their marker is like 0.6. What's our CPI? Two. I don't even know what it is. I don't pay attention to it. It's imaginary numbers. But according to Trueflation, it's less than 1%, which means we have close to deflation. Which means that interest rates are going to start to drop. Now, they're clearly going to drop in May once we get a new Fed chair. But until then, Powell's kind of he's a bit of a whiner right now, and he's being a stick in the mud. And he's I'm not going to lower interest rates because I don't like you, Trump. Like, I think that's probably what's happening. But that's my speculation. We'll never know. But anyway, so interest rates are probably going to decline, which means that you should probably have some bonds in your portfolio. We haven't liked bonds for a while, but I kind of like them now. And so if you don't have bonds in your portfolio, you should. If you don't understand why they're there, you should understand that. Most people don't. Most people don't understand why bonds are there. Bonds right now, if you look at the greater picture, here's the kind of the thesis at the moment, is that interest rates need to decline for various reasons. I won't get into all of them, but basically they need to decline. And so they will decline. And mortgage rates are going to start to decline, which means I would speculate mortgage rates are going to be down at least 1% this year by election time. At least one. Could be more, but I would speculate probably around 1 by the election time. Now, if that's the case, your mortgage is going to get a lot cheaper. It means your payments are going to get a lot cheaper. It means you're going to have more money in your pocket to spend. It means housing is going to be more affordable. I speculate that mortgage rates will probably keep declining for the foreseeable future. which means that we might be back to the old way. I didn't think so. I didn't think we'd ever see 2-3% mortgage rates again, but I'm thinking now we might. Based on all the research I've done, the people I've talked to, I think there's a very strong possibility we are back down to those lows, which should make all homeowners celebrate. And if you're not a homeowner, go out and buy a home and celebrate, because that's going to make things a lot more affordable for you. Now, if you're looking at interest rates declining, then you should be in bonds that are, and this is not a recommendation, this is not advice, but if you're seeing that interest rates are going to start to decline and you're seeing the curve flattening or inverting again, which I suspect it might, then you probably want to own the long end of the curve. No, that's more risky. To be clear, that's a lot more risky being the long end of the curve, but that's where more money is made in bonds. The short end doesn't move as much. You don't tend to make as much if bonds decline in the short end. On the long end, you make a lot more because of varying degrees, duration, other things. But basically, what you'll notice is, just understand this fact, I won't get into all the detail, is that the long end will make the most money as rates decline because the price will go up. There's an inverse relationship. Price and yields are inverse. If the yields go up, prices go down. If prices go up, yields go down. That is an inverse relationship always. So if you want to make money on bonds, you want to be in the long end. If you want to be safe in bonds, just stick to the short end. You'll be fine. But just understand that is what you would want to do if you think interest rates are declining or the curve is flattening. Either way, you want the long end to come down. These are also happen to be safer investments, because bonds, if they're declining in yield, they tend to make money and they tend to be more stable in a portfolio versus equities, which can go all over the map. You see what happened with crypto. It's been a flaming pile, a dumpster fire, and I don't know if that's going to stop anytime soon. So we'll see. But if you want to take risk off the table, bonds are a good place to take risk off the table right now. Once again, this is not advice. I'm not saying do this. I'm just saying this is the kind of thing you would do in a risk off period. There are many ways to manage risk. That is one of them. That's why people have bonds. They don't have bonds because they think they're going to outperform the S&P. They think they have bonds because they want to moderate the volatility of their portfolio. Now, we have not owned bonds for quite some time, but I think it's probably not a bad time to have some in your portfolio. The yields are still okay on the long end. Even on the short end, they're okay. They're not great. They're not terrible. They'll probably become terrible over the next year or two. But, in the interim, you can at least make money off that before the yields decline to zero again. So, I think it's important. One of the things you want to do with war, and I'll move back to Doug, and we can talk about kind of the thesis again, because I want to get back to the things I want to talk about today. Is you want to, rather than listen to speculations about what's going to happen in the market with all the warmongers, and there's a lot of people out there that are just drooling over war. They just love it. I think there's some crazy people out there, and we shouldn't be blowing anybody up. I know strategically it might be the right thing to do, but you should never wish for death. Okay, that's a bad thing. But I want you to start to think about this. There's going to be a lot of warmongering, a lot of fear mongering, a lot of people trying to get ratings, a lot of people speculating on stupid stuff that isn't true. Don't listen to any of that unless somebody's an expert in Middle Eastern war. Don't listen to that. And even if they are, you should still take it with a grain of salt. But what you should be looking at is history. Historical events similar to this, how have they evolved? What has happened in those historical events? What happened in the Iraq War? What happened in September 11th? Probably not the best analogy, but it's similar. What happened in the Ukraine War? What happened in 2023? What happened in these times? What happened in 1990? Like during these events, like what happened in the markets? How did they react? That's how you should be looking. We have no idea what the future holds, but we can speculate on what it will do based on what it did in the past. It's not 100% chance that'll happen, but it's the closest thing we can find. because we don't know how this will unfold. We don't know what's going to happen. Maybe they close the Strait of Hormuz. Maybe they don't. Maybe this war has ended in 5 days because they're just like, we don't really care. We were just saying that because we didn't want to get persecuted, but we really want American, capitalism here, and women want to remove their burqas. I have no idea what's going to happen. No one else does either. So look at what happened in the past and say, all right, based on the past, here's how I would operate my portfolio. Here's what I would change. Here's what I would be careful of. That's how I would look at your portfolio right now. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. I'm going to give it over to Doug. I don't know if I'll have a chance to talk about the things I want to talk about today, but what are your thoughts, Doug?
One thing you talked about, I want to go back to the bonds conversation for a second. I think the simplest way to think about fixed income is that, first of all, it provides yield. The point of fixed income is income, right? So ultimately, what it's going to do is going to add some liquidity to whatever sleeve that you want that is safer in your portfolio. And it's going to allow you, when you're kind of holding that money there more than generally cash, to be able to have something come in and, not expecting much. I mean, yes, people will speculate on getting an appreciation or depreciation of bonds, which are affected, as you said, based on interest rates and the long end, short end. But the reality of it is bonds expect anywhere from, depending on how short to how long, 1% to 5%. I mean, again, that can change if we go through a cyclical kind of stagflationary period. Sure, if the government ever decides to just raise interest rates to combat it, like they did in the 70s and early 80s, sure, it could be higher than that. But that's generally going to be something that's going to be your more expected type of return on that, and it's meant to be a holding spot for you to balance in and out of cash. And so the thing to remember, I think, is understand that it's always against the safe haven, and the safe haven or the safe bet, the risk-free. Cash is a risk-free situation. So if we were to take a look and you were going to put that into perspective, if you feel that risk-free you can get more money, okay, by sitting in one place than bonds, okay, and the government is giving you an interest rate, they're paying you to buy their bonds. If they're raising interest rates on the short-term end of the spectrum, it's not going to be in your best interest to wait on the long end of the spectrum and watch the fixed interest that they're charging go down as the government's raising rates on the short end, which is when you want to be more on the short end of the bond spectrum. If we look at, like Kirk's saying, you're saying, Kirk, the interest rates are going to go down. Well, then are they going to go below what the longer term interest rate's going to be? And if it is the longer term safe enough to warrant that higher interest rate and holding on to it when the rest of things that you're either getting paid on interest are going down? And that's why, again, if the federal government is looking to lower interest rates, therefore the new issues in short term are going to be lower interest, then the longer term, having a fixed long-term interest rate is going to be potentially in that environment the safer place to be. And ultimately, this is something I think is really important to understand as investors, is that there's been a lot of talk, and we've talked about it the last 15 years, that we have been sitting in a world in which passive investing has really been driven as the narrative. And passive investing has been the right place to be. Okay. And there's a lot of people that have pushed passive investing, low cost passive investing as the only place to be. And they've been right. And they've built incredible followings based on this. But that comes with an asterisk. The reason is that if we look at the S&P 500 and you pay most large cap, funds or investments to be in the large cap, you're going to find that it's been very difficult to beat that return against the index. Why? Because again, the S&P 500 index itself being correlated to the highest market cap, what's really got the momentum and the heat in the S&P 500 is going to drive the S&P 500 index. So trying to outthink that is very difficult amongst 500 stocks for a manager. Vanguard, obviously one of the greatest proponents as a company for passive investing, the whole John Bogle philosophy. But Vanguard themselves have written white papers on where passive investing tends to do better and where it tends to do worse, and areas in which active investing still is a place where you can be in better position. And one of those areas, amongst others, is fixed income. Fixed income is so difficult to manage, especially when you look at a index that covers a broad spectrum of fixed income, or an index that is very specific to either short end of the spectrum, long end of the duration, long end of the duration. And they have found that active investment in the fixed indexed area has outperformed passive the majority of the time. And what you're talking about, Kirk, has a lot to do with that. It's because there are so many different variables that go into when and where short versus long term. And you don't want to be spread out amongst them, for the most part, just sitting fixed, in a passive, because as the low end of the spectrum becomes less favorable on bonds and the higher end of the higher end of the duration becomes more favorable, or vice versa, it's an erosion of the ability of a diversified holding of bonds to be effective in that variable interest rate environment, which is where, if you're going to hold fixed income in your portfolio, this is a place to consider having kind of more of an old school mentality. Either you have a manager that understands fixed income, and they are a very, very specified niche of individuals. And I got my CFP. I've talked about this. The guy that taught our CFP review class was a bond trader on Wall Street when the markets crashed in 1987. And we kind of joked with him. He said, yes, that was a very good day for me. Right. And I think it was only like 7 to 10 of them that were experts on Wall Street at the time. It is a very specific niche. Now, the growth since 1987 of the investment industry has been exponential. So there's a lot more out there these days that are between that you can give you access to than just money makers and traders that are built into this. But again, we've gone away from mutual funds. We've gone away from active trading in so many places. This is an area where you might want to consider more of an active traded ETF or an active traded bond or a mutual fund, or someone who really understands how to place and buy individual bonds based on the environment, versus just doing something passive. Passive will be better than nothing, but I think it's really important to understand that the whole argument about passive investing has really been generalized, like so many pieces of advice are. People will use this as a snippet, kind of like Roth conversions. This is a selling point for a lot of advisors. Everybody should do Roth conversions, right? And they'll get people to do it. They'll acquire customers over it, and they'll do seminars on it. The reality is it's not great for everybody, and it is certainly better based on the timing of your life and income than just being this wonderful tool. But they use this as a buzzword to get you interested. The same thing has happened in passive investing. And at the end of the day, it's great. It can help people acquire a lot of clients and get a lot of following. But this is an area where passive investing has definitely underproduced over time. I just want to, I took a little bit of time on that, so I want to go quickly on a couple of other things. Um, historically, fear versus history with the market reaction to Iran. Markets will feel like you'll see headlines like World War III risk, oil spikes, gold spikes, futures red overnight. Okay, and the futures today were a little bit lower here. They were the actual markets are a little less, and that were already they're already active in Europe and Asia. So probably going to get a little more reaction today. Listen, markets react to missiles emotionally, but historically they don't trend bear unless oil supply or credit breaks. So yes, is there concern over the Strait of Hormuz getting disrupted? If oil jumps 20 to 30% sustainably, or that's going to feed into inflation expectations. So if there's a short-term spike, the markets will digest it. I mean, we've seen, as you showed, Kirk, less than 10%, generally 2 to 7%, market pullback on average over a 3-month period. Over a 90-day period, that's nothing. Now, we get average 14% drops in any regular year, so it's a meh. But now, if we get sustained 120 plus oil, that's going to change CPI trajectory. That's going to put pressure on the Fed. That's going to pressure equities. So right now, oil reaction looks fear premium, not supply collapse, and that's critical. What about the dollar? When geopolitical fear hits, money's going to go to safe havens. What are they? The U.S. dollar. Doesn't matter what everybody tries to talk about other currencies out there. The majority of currencies are either going to be less stable, less trusted, or if they're more trusted, something like this, the Swiss franc, which has been consistently strong, their economy, their GDP really isn't, big enough to be the backer of global currency. Things like the Swiss franc can be a temporary play when, if you're getting into monetary trading, which I never recommend, highly risky. Okay. Now, money's also going to go into the treasuries. Money's going to go into gold. And when this happens, it is reflexive. Short-term dollar spike equals flight to safety. But long-term, here the twist to that is it can lead to more massive U.S. debt, heavy treasury issuance, fiscal deficits, a de-dollarization chatter with the BRICS. So a dollar spike on fear does not equal structural strength. It can actually equal a liquidity preference. You talked about lower interest rates for mortgages. Great. That'll be great for all of you that are looking for a cheaper money to buy houses. But again, like everything, pros and cons. What is one of the problems that we're facing right now? Of course, some of it is that there is nothing moving. Everything's locked up. That's a major problem. But prior to real estate locking up, the headlines going into 2020 was that, yes, interest rates were still low. They were still in the 2.5, 3.5. You could get a great mortgage, but everybody was trying to get one. There was so much demand for mortgages, for housing, that what happened to housing prices? They went through the roof. So hey, great. If interest rates come back down for mortgages, it probably will unlock, because now you'll get a lot of legacy homeowners finally ready to move to try to buy something cheaper at a lower interest rate. You'll get a lot of the baby boomers to unlock. But guess what's going to happen? You'll get back into bidding wars. And even though you'll have cheaper money, you'll still have a huge payment if you're going to be locking in on a significantly higher price of against that supply. So trade-offs for everything. The dollar's going to rely on fear. Structurally, that comes down to its fighting debt gravity. So let's take summary what it looks like we're seeing between collapse or rotation. Tech's been weak. Defensive steady, energy, metals volatility, dollar firm. A lot of it's rotation. We've been saying that it's not systemic. Collapse would look like credit spreads exploding. Kirk, you said they're not happening. Banks under stress, maybe a little bit there, but not enough to cause that black swan to have things implode. I saw some things the last couple of weeks. Oh, a bank just collapsed. It was literally like a $16 million, collapse. Nothing. It was a small bank in, I think, Illinois. Nothing that's going to move the needle. When we start seeing major banks with billions and billions of dollars, that's an issue. But the government's told us the last decade they'll just step in and sweep it under the rug. Probably would again. If liquidity dries up, we can't get money. That was a 2007, 2008 issue with liquidity locked, forced selling everywhere. That's when we would be concerned. We're not there. We're seeing risk being repriced. We're seeing duration getting pressured, high beta assets resetting, and it looks more like capital rotating under stress than capital fleeing the system. So I just, again, last thing I'm going to say, the media, you talked about it. The headlines are going to be dramatic: war risk, collapse, asset implosion. Media monetizes fear, war, red charts, systematic collapse. But markets are forward looking. They're going to be more resilient. Historically, military strikes are volatility events, not economic events. Again, if you go into modern portfolio theory, something we don't fully subscribe to, but when they did, or really don't, but when they did do that, they said that economic event or world events like this were less than 1% of impact on the markets. It's very small. The media is going to focus on emotion. Markets, they're focused on liquidity, energy flow, credit. Ultimately, fear gets clicks. Liquidity moves markets. So best case out there, there's going to be short-term volatility from Iran. Dollar, near-term strength, structural, vulnerability remains. Equities, choppy with this midterm election coming up. Typical behavior, not systemic breakdown unless credit cracks. Really just continue to watch credit. Metals, volatile digestion after extreme runs. It's not invalidated, it's just repricing. And the media is just going to keep you on edge. So, that's where I'd be right now. I wouldn't be too concerned, but again, watch the bond yields.
Yeah.
They'll tell you everything.
So I'm going to share a few things here just to give some reference points for where we are right now. So this is the markets. This is the S&P 500 stocks, and based they're grouped by sector. We use this a lot on the show with FinViz. But if you look at these sectors, let's see how the market's doing. And by the way, if you haven't paid attention, the Qs are only down 0.5%, and the S&P is only down 0.4%. That's crazy. Like, that's it. That's what we got. And apparently nobody seems to care about the war. This is the point of
that looks like a typical day, Kirk.
Yeah, I know. This is so if you look at the audio viewers, basically the financials are a mess as they were last week, so that's not a surprise, but they're still a mess. Energy's done well. All the other sectors, I mean, Nvidia's up a little bit, don't know why. Microsoft's up a little bit, but the rest of the sectors are down a little bit. Just a little bit. Not a lot. The materials sector is not doing well. Energy is doing great. Utilities are kind of flat. If you look at all these sectors, it's really not all that bad, surprisingly, except for financials and apparently
Berkshire just continues to get
and consumer cyclicals too. They're not in good shape. But if you look at the futures, I mean, we are. I mean, these are a little bit delayed. It's actually gotten better. So if you're looking at these, really what we're looking at is a market that doesn't really give two craps. Like, really? Like, we have a war going on. No one seems to care. Okay. So what you should take away from that is this. When we're looking at markets, what you think will happen is not always the case. It's actually very rarely the case. So don't expect your fear sensor to drive your expectations. Just because we have a war doesn't mean the markets are going to zero, doesn't mean the markets are going to crash. It doesn't happen that way. It rarely does. Now, here's what I want to share. And I'll get into this next week, but this is something I really wanted to share. Now, this is as of last week. Now, what it's showing is the different sectors in the S&P 500. There's year-to-date performance, average stock year-to-date, and then there's sector allocation. Now, what I really want to show is performance and allocation. So let's look at all the sectors. What are the biggest sectors in the S&P 500? Technology is a third of the entire index. Nothing's even close. The closest thing is financials with little less than 13%. So a third of a third is what financials have. And so technology is a huge part of that. And, communication services and consumer discretionary also have some big tech in there. So realistically, it's probably about 40% is tech if you include all the Mag 7. But let's look at the other sectors. Utilities is 2.25%. I'm sorry, 2.5%. Healthcare is 10. You have industrials is a little less than 10. Staples are 5. Materials are 2. And energy is 3. So imagine for a second, the best performers of the year so far are energy, materials, staples, industrials. Now imagine for the moment that the sectors that we talked about in the last few weeks, staples, utilities, healthcare, healthcare being 10%, but utilities being 2.5%, and staples being 5%. Imagine for a moment you're trying to get 33% of the money, which was in tech, and let's say tech starts to not do well, that money's going to flee. Then the prices are going to go down, right? Prices go down, money flees. Even if the money stays, the prices go down, it's going to drop, let's say, by half. Now it's 15% of the index. Where's that 15% going to go? Can it go into materials at 2%? Those stocks are going to be up like 400%, right? No, it can't go into materials. Can it go into real estate? Probably not. Not real estate's kind of a mess. Utilities, it's definitely going to utilities if the market starts declining. That means utilities are going to double from here. That's ridiculous. That would mean PEs have doubled. No, you shouldn't have double the PE for utilities. What about staples? 5? Could it go to 10? Maybe, but they're already expensive. The PEs are already expensive for staples. Healthcare, yeah, you could probably see it going there, but I mean, I don't know. I don't like healthcare right now. But regardless, the point being is you're looking at 33%, or let's say half of that. So 15% is going to shove into a total of 10%, maybe 20%. Highly unlikely. So I want you to think about, where's that money going to go? Is it going to go to those sectors? Yes. So the defensive sectors will get money from the risky technology, right? Risk off or rotational. We're rotating out of tech into other areas. It's rotating into utilities, staples, healthcare. Right now, it's going into energy, materials, and industrial, as we've seen, but it's also starting to get into staples. So what tends to happen is this rotation. It goes from tech, communications, and then it moves into energy, materials, and industrials. That's kind of the peak of the market we shared the other week. The peak is those energy, industrials, and materials are the peak. And then once it starts to go into a recession, then you see staples, utilities, and healthcare in that order. And then at the bottom of the market, then it starts to rotate back. So it's important to understand these rotations if you're an investor, because if you're just an indexer and you're like, yeah, it'll be fine, the index goes down like 20%, is it fine? Okay, I guess that's what you want. But you don't have any bonds in there. So when you talk about indexing, they're not, the S&P is not bonds. So if it goes down, sometimes eventually, if people are like, I can't put money in utilities, it's too small, they're just going to flee into bonds. And that's what happens, right? So if you think of the rotation, right, in the sector rotation, the stock market doesn't include bonds, but when you start to get into recessions, people flee into bonds, interest rates drop, which means people want to be in bonds because they'll do well. Real estate tends to do well when interest rates drop, so do utilities, because they're both yield sensitive. However, real estate's kind of a mess, so I wouldn't say that would be, I would kind of, in general, I'm steering clear from it just because it's kind of still a mess. But utilities is yield sensitive. So, people buy utilities for the yield. It's similar to a bond in that way. It's not a bond, but it's similar to that. So you ought to be looking at, where is the money flowing? We are no longer an economy of fundamentals. We're an economy of money flows. So where's the money going to be flowing? Right now, it's flowing to the dollar. It's not flowing into bonds, oddly enough. It's flowing into crypto, oddly enough, but crypto's kind of hit a bounce here. We'll see. But it's, if you look at the markets are crazy today, given there's war going on. International markets are taking a hit for sure. That's probably due to the strong dollar. But if you're looking at where things are going, they're not going the places you think they should be. So we're going to talk about this more next week, because money flows in the system is what drives markets. It has been for at least 20 years. And it seems to be the only thing driving markets, because fundamentals seem to no longer matter. There's a lot of great companies out there that are just getting taken to the cleaners, and people are overpaying for 80 PE companies. So eventually that has to correct itself. But for the moment, you want to watch the money flows. And right now, these are where the monies are flowing. Performance is where money's flowing, right? People chase performance. That's where it's going. Energy, obviously, I'm staying clear of energy right now. It's too political. But obviously there's efforts going in there. So we're going to wrap it up for this week in the interest of time. So Doug, where can people find more about you?
Listen, Kirk, I mean, I think we covered a lot of things today. As we close today, here's really what matters. Yes, there's current Iran tension. Oil spikes are probable. They've already occurred a little bit, probable in the short run. Long term, unknown. You just talked about again, if you're into indexing, like I said, I think it's really important to understand where, and you said that fundamental. It's about money flows. Fundamentals haven't worked for a long time. I mean, do they in some degree? Yes, but as you know, if you're a value investor, it's been a really rough road because we have a world that has been driven more and more by computers. Computers aren't looking at the fundamentals. Traders are looking at where more technicals, where they can take opportunities to flush into the market, flush out of the market. You're going to see more dollar swings, more market volatility. And most of this stuff is going to be driven by noise. And what determines whether it hurts you is structure. And this is where, I firmly believe that this, with what's going on right now and with so many things that continue to change with this rotation, this is where wealth mapping stencils can become powerful. Stencils help you not just see what you have, but how households like yours what they typically have. Think of it as a financial version of Netflix saying, people like you have this. You might be interested in this. It's simply a placeholder. We look at this as something that, again, when you're putting together your plan, what do your peers commonly use? We look at it here to discuss whether it belongs in your plan or why. Why is this? It's clarity. Clarity is what's going to allow you to build income guardrails, which are going to allow you to look at the volatility of the markets and say, hey, are we still okay? You know what? You are, because ultimately what you're hearing is the noise. What you're hearing is this volatility. What the media is just pounding into your eyes and ears. That isn't the reality of what's affecting you. That separates lifestyle funding from market exposure, so those headlines don't dictate your decisions. When markets flash red, families with structure don't panic. They evaluate, they adjust, and they move intentionally. So if you're unsure whether your plan has the right guardrails in place, that's exactly what we work on with families here at Mergent Advisors. If you want to find out a little bit more about that, go to our website, mergentadvisors.net. That's MERGENT advisors.net. Schedule a conversation with clarity and see where your wealth map might need some strengthening, how you compare to others in terms of having things in place, and regardless, ultimately have clarity about what you have and where you want to go. Because the thing is, volatility is going to be inevitable. Being unprepared, that's optional.
Great. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.